on the shelf. Cause the way the real wealth is being real itself. Might not haven't seen the glory of the coming of the left. I can't do it by myself, so I'm asking for help. It's time to switch it up and put the hip shit on the shelf. Cause the way the real wealth is being real itself. Might not haven't seen the glory of the coming of the left. I can't do it by myself, so I'm asking for help.
Money. All you have is money. Being wealthy. Like Kanye West says, having money is not everything. Not having it is. Deuteronomy 8:18 says God gives us the ability to create wealth. No, it's the love of money that's the world. You don't like money so much, why you get up and go to work? Yes, I do think about money. I'm just trying to leave a legacy for my kids. Not everything, but when you got it, you can do some cool stuff. Now, your host for Talking Money in the Morning, financial mentor to working class, H Cortez.
Good morning. It is your main man, H Cortez here, the one and only financial health mentor to the working class, where I do my very best to bring practical yet proven wealth building strategies to working class men and women all over this great nation of ours. And you are checking out Talking Money in the Morning. So glad to have you this morning. You know, it's an honor and a privilege to be able to share with you guys the little bit I know about building wealth and taking your financial future to another level. So I thank you. If you're checking us out on Facebook Live, please give me a okay that the audio is okay. I've done a show where the audio was crappy the whole show and nobody let me know that they couldn't hear what I was saying. So type in the chat that you that the audio is okay this morning. And if you're tracking, go ahead and share this with a friend or two on your Facebook timeline. And then if you're tracking us on YouTube, then do me a huge favor and subscribe to the YouTube channel and then share that link, because they can watch it live wherever you share this link this morning. So let's get right into it, because I've got a quick little dissertation that I want to go through. And then, as promised in the description, I want to get into some screen share and show you guys that you can get better rates of return on your money. I'm telling people all the time that you can easily get 8, 10, 12% rate of return on your money. And they look at me like I'm crazy. Because they don't know where to look. So I'm going to show you that on screen share. I'm trying to get centered on my camera here. Which way do I need to pull this thing? This way? Does that center me a little bit better? Okay. So yeah, so I'm going to show you on screen share, but there's some things that you have to do before you can really start investing. You have to get yourself prepared in a certain manner. So before we get into that, I have to always let you know who this show is for. If you woke up this morning and you are ready to rise and grind, you're ready to get up and get something, this show is for you. Remember that song by Outkast? You got to get up, get out, and get something. Don't let all your time pass you by, guys. We are living in a time where, metaphorically speaking, time is actually moving a lot faster than we really realize. So things are speeding up. So you don't have as much time as you think. So you got to be getting up, getting this legacy done, getting your finances in order. So if that's you, this show is for you. If you went to bed last night and before you fell off to sleep, you read your affirmations and you visualize where you're going to be a year from now, 5 years from now, 10 years from now, this show is for you. If you have the desire to be wealthy, if you have the discipline to be wealthy, but maybe you're lacking a game plan, some guidance, a mentor, this show is for you. Who is the show not for? It's not for those people who got that weird relationship with money, because those people always repel money away from them versus people like myself. I always attract money to me because I have the right relationship with money. I know it's just a tool and a resource, right? So if you have one of those weird relationships with money, this show ain't for you, right? If you're waiting for somebody to fix the economy instead of focusing on your economy, this show is not for you, right? And guess what? I don't have a problem with you not wanting to be wealthy. Just let me make that clear. I have a problem with you, have a problem with me wanting to be wealthy, because that's what I get all the time. All you talk about is money. So what? That's me. That's my prerogative. So I don't have a problem with you not talking about money. So you shouldn't have a problem with me always talking about money, me wanting something more for my family, me wanting to have an abundance of resources instead of a lack of resources, because that causes all sorts of stress and strife when you lack resources. Guys, we can look all over the world and we know that certain countries lack resources. And I'm talking about resources like clean water, resources like food, right? And what does that create for those countries? All kinds of strife, all kinds of stress. So the same is true in your personal and individual life. So I want you to know that if you have a problem with me wanting to be wealthy, then I have a problem with you, because that's you know, to each his own. So let me do my thing. I'm going to let you do your thing, and I'm not going to judge you for not wanting to be wealthy, and you shouldn't judge me for wanting to be wealthy. So this show is not for you. You can tune us out, and that's perfectly okay. Today's show is sponsored by myself. Guys, if you're in the St. Louis area, I'm having a wealth building workshop. It's going to be at a small church called Willing Workers. The address is 5631 Wells Avenue, St. Louis, Missouri, 63112. Again, if you're in the St. Louis metro area, East St. Louis, St. Charles, O'Fallon, I want you to come out, and I'm going to be doing a live wealth building workshop for about 90 minutes. I'm going to teach you my income shifting strategy so that you can see how you can put your money to work for you better. You can ask me questions. You can get an understanding, a better feel for the wealth building strategies that I actually teach. So again, it's called Wealth Building Workshop. Send me a private message. I can send you the Eventbrite so you can print out your ticket. It is free, but I do need you to RSVP because the space is very limited. So again, the address is 5631 Wells Avenue, St. Louis, Missouri, 63112. And I'll put that in the description of the video. And also I'll put that as a comment under the live stream so that you guys will know that's where we are. I do have an event set up for that on my Facebook fan page, Financial Health Mentor. So you can go there and RSVP through that event page as well. So now, today we're talking about how you get a better return on your investments for those of you who like to invest in the stock market. I'm telling people all the time, I wholeheartedly believe with Robert Kiyosaki when he says savers are losers. Now, that's a double entendre, meaning that you could construe it as I'm calling you a loser. But no, I'm talking about literally, if you're trying to save money in a bank, you are a loser, because what's going to happen is you put your money in a bank savings account. That savings account is going to pay you less than 1% rate of return on that investment. The rate of inflation on average for the last 100 years has been at least 2%. So if you're getting less than 1% in a savings account, then you can understand why Kiyosaki says savers are losers, because the value of the dollar is going down faster than you're earning interest in a savings account. Now, that's the average. Sometimes inflations hover around 5, 6, 7%. So even if you're saving through a CD, and sometimes an average CD may pay you 3.5%. And if inflation is tracking at about 7% during the time that you own that CD, guess what? You are losing, right? So that's why you have to understand how to get the best rates of return for your money. We're going to talk about that today. But here's the deal. In order to truly get the best rates of return for your money, you have to prepare before you even start investing. What am I talking about when I say preparation? You have to, number one, eliminate debt, right? It's virtually impossible to build wealth while you're drowning in debt. So you're going to have to get rid of your debt, especially credit card debt and any other revolving debt. What do I mean by revolving debt? It's that debt that you pick up month in and month out. It's a debt that you can pay a minimum balance on, but the compounding interest is going to continue to grow that debt. So you have to get rid of that stuff so you can better put yourself in better position to invest. So number one, before you can start investing, you have to prepare yourself, and you prepare yourself by it's a given that you're preparing yourself to study and learn, watch shows like this so you can know. So that should actually be number one. You acquire the knowledge and a mentor to help get you, guide you. But then you have to eliminate your debt to better put yourself in position. Once the debt is gone, do you start investing then? No. You have to go ahead and put an emergency fund in place, because what happens is you get rid of your debt, you start investing, and then you have an emergency come up. That's going to put an interruption in your progress. So then you're going to mess around and take money from your investments to fix that emergency. So if you get out of debt, you set up an emergency fund, 3 to 6 months of your living expenses. Now, when you start investing and that emergency comes up, you go to your emergency fund to get that taken care of. And now it's not a true emergency. It's just an inconvenience. Understand the difference. The difference between an emergency and an inconvenience is your money to pay for it, right? If you got the money to pay for it, it's just an inconvenience. When you don't have the money is when it becomes an emergency, right? And then once you have gotten rid of your debt, you got your emergency fund set up, now you can go ahead and start investing. So we're going to talk about that. I'm going to show you some screen shares on how you can get the best rates of return for your money. But I have to give this disclaimer. I am not a licensed financial advisor. This is not financial advice. I'm not a tax professional. I talk about minimizing your taxes and things of that nature. I'm just a financial educator who's learned some strategies that I like to share for informational purposes only. So now that the disclaimer is on the books, what I'm going to do is I'm going to a screen share, and we're going to use Bangor. I'm going to go into Bangor, and I'm going to show you how you can get some higher rates of return on your money. But then it's going to become even more clear why you have to do these first 3 steps. The first 3 steps before you start investing. Step number 1 is you have to get your knowledge up. Step number 2, you have to get rid of your debt. Step number 3, you have to create your emergency fund, and then you can start investing. Because when you don't have any debt and you have an emergency fund, you can be a lot more aggressive when you're investing. And when you're aggressive when you're investing, that's where all the money is really made. But why are people not aggressive? It's because they're playing this money game with the money that they also need to be eating with, right? So they're scared to lose it because this is money, this is rent money for next month, right? But when you get that taken care of, out of debt, emergency fund set up, now you're not playing with rent money. Now you can be more effective, and you can be more focused, and you can be a little bit more aggressive. And we all know with anything, not just investment, the greater the risk, the greater the return. But you have to be free consciously to be willing to lose and take those risks, because I'm not playing with my rent money, guys. All right, so we got about 17 minutes or so. So let me go into screen share. Facebook Live, guys, you won't be able to see the screen. If you go down below this video, I also posted the YouTube link. So if you want to jump on there so that you can see the screen share, then certainly by all means do that. But I'll try to explain what I'm showing on the screen as best I can for you guys, because I love Facebook Live. The videos turned out really good. I can't do them on my phone. I still have a Galaxy 3. My wife has this good Galaxy 6 or 7 or 8 or whatever number they're on. I don't believe in paying that much for a phone then when I got one that's working pretty good. So let me go to screen share. Bang. All right, so hopefully everybody is seeing my screen. Right now it's just on the YouTube channel where I set the event. So I'm going to go right into Bangor so you can see me going into this from scratch. So it's not like I'm creating some slides with some false numbers. I'm going to go in from scratch like I would be teaching you if I was mentoring you. Let's see. So Bangor.com. All right. Now, guys, I also want you to know this about me. I'm not the greatest at this stuff. I subscribe to a methodology that says you learn, you do, and you teach simultaneously. So some of this stuff I'm still learning while I'm teaching you guys, but it's in the teaching you guys that I actually master the material, right? Uh-oh. All right. So it looks like it froze up on me, Facebook Live. It's trying to reconnect. Looks like you guys are back on. So I learn, do, teach simultaneously. So as I'm learning this stuff, I'm sitting down with my mentors and I'm getting this stuff. Then I like to also teach it at the same time because it helps me learn even faster, lets me cement the information in me even more. So we're on Fidelity's website, and as you can see, they have a tab that says personal investor. What does that mean? You don't have to be a broker, you don't have to be a bank, you don't have to be a licensed advisor to be able to come in here and get a better rate of return for your money. You do, however, have to know what you're looking for. So we went into the personal investor tab, and then we're going to go into investing, and then it says investment products, right? So it gives a list of their investment products. So I'm going to, I kind of know what I'm looking for a little bit. And because we're short on time, I'm not going to give you a full runaround of their website. But if I go into the search and I put in corporate bond fund, I just started typing corporate, but what I'm looking for is a corporate bond fund. And all that is a fund that you can buy, and that fund houses a bunch of corporate stocks, right? It's not one company's stocks. It's what they do is they lend this money to hundreds and thousands of corporations. And that's where your yield comes from. It comes from the interest that those corporations are paying back to this fund. And I'm going to go into this one right here. Let's see what it's going to show us. I'm actually going to go into select a short list of their different funds, and you can get an idea of how many different funds they have available and what the different interest rates are on multiple funds, and you can actually compare these funds. So if I scroll down, you guys are tracking with me on Facebook. So basically what I'm looking at is, if you look at the number on the far right-hand column, it tells you the rate that this fund has been performing at since its inception, and it also tells you the date that it came into B. So it tells you the date that the fund started and how it's performed since it began, right? So if you're looking at this one, it says it began in November 2001, and it's been performing at a 4.61% return since its inception. Now it's had some ups years, some down years, but on average, the fund has performed at 4.1%. But we're not looking for that. So we're going to go and just scroll down the list. You see some 5%, some 6%. You see 5.89. Then you get to this one, a 9.96% since inception, guys. And guess when it was? Guess when it was created? This thing has been performing 9.96% since 1970. So when I tell people you can invest in the wholesale market and get double-digit rates of return, they're looking at me like I'm crazy, because they don't know, because they talked to some broker, because they talk to some banker. And what does the banker do? Guys, if you haven't checked out my show on the real banker's secret, I want you to go check that out, because I broke it down to what bankers really do. Most people think that a bank takes your money, lends it out, and that's how they make their money. It's not how a banker does it. A banker takes your money that you put in your savings account, and they promise you less than 1% interest. Then they take your money, they bring it over here to Vanguard, get 9.96% rate of return, and then give you less than 1%, and they profit the rest. See, what a bank really does is banks do two things. They buy currency and they sell debt. And if you don't understand that, you don't understand the language of money, then that's one reason that you're struggling to build wealth. Banks buy currency and they sell debt. Why is that important to know? Because where do they buy it from? They can buy it from the Fed, right? And the Fed may be at a 2% rate, a 2% interest rate on the currency that they sell in the banks. But if I can buy it from you for less than 1%, what do you think I'd rather buy that money from? They buy it from the general public in the form of selling you on the fact that they're going to keep your money safe and protected. So you put your money in a savings account for less than 1%. They're buying your currency. Wherever you hear the word interest, there's a loan taking place. So you're loaning them your money at less than 1%. and then they're going to take it to Vanguard, get 10, 12, 15%, and give you your 1% and profit the rest. So check out my show a couple weeks back on the real banker secret. I break all of that stuff down for you. But that one is 9.9%, 9.96%. Since its inception, 1970. Here's another one, 9.05% since 1967. Here's another one, 9.77% since 2001. Here's another one, 10.2% since 1968. Here's another one, 8.7 since 2000, 10.59 since 1985. Are you guys getting this? Now, here's why you have to prepare to be able to take advantage of these situations. So I'm going to go into which one was the highest that we saw, 10.20, 10.59. So 10.59 was the highest that I saw. And I chose a certain criteria. So they, trust me, they get even higher than this. But let's just say we at 10%, 10.59%. So I'm going to click on this one, and we're just going to look at some of the details on this one. We got 9 minutes, guys, but hopefully I've given you enough so that you can understand how to go into these investment houses and deal directly with them versus going through a bank or a broker. That's what we mean by investing wholesale versus retail. You go to retail, you go into the middleman, goes directly to the source. This is where they're going to take your money. And they're going to charge you, or they're going to profit the difference between what you know, right? Again, capitalism isn't good. It's not bad. It's just, it's based on those who know being able to capitalize on those who don't know. So now that you know, and you sit down to your broker and he says, hey, we got this great deal, man. We're going to give you this 4% investment package. You say, wait a minute, if you're giving me 4%, I know that there is way more than 4% to be gained, because you're not going to give me 4% and not make a profit yourself. So when you go into the actual system, you'll see that this is the Vanguard Windsor 2 fund investor shares. So basically you buy shares of this fund, and this fund lends money to corporations, and you see that the expense ratio is 0.34%, at 68% lower than the average expense ratio for funds with similar holdings. Now, when I talked about being prepared, eliminating your debt, creating your emergency fund, why? Because when you eliminate your debt, now you can stack your chips. Now you got some money. Here's why. Because in order to you get into this fund to start earning this 10.59%, you got to come to the table with a minimum investment of $3,000, right? Most working class people cannot do that. That's why they go to the bank, because the bank will play around with you and let you open an account with $100. They'll let you open a CD with $400, $500. These guys saying, hey, we want the serious people who want to invest their money, and we know that they're going to leave their money here long term. The longer you leave it, the more money they can make, and the more money they will pay you out, because they're lending your money over and over and over again. So you need a minimum of $3,000 for this particular investment. It talks about the risk potential. We talked about, again, the more risk, the more reward. So on the risk scale, this is a 4 out of 5. So yes, it's risky. But again, we're talking about a fund that has paid on average 10.59% since 1985. Do you think the people over at Vanguard who's managing this fund know what they're doing? Know who to lend this money to that's going to pay it back at a good term so that the fund continues to make money? Right? Do you understand what's happening here? All right, let me see if I can. Let me see. And if you go down a little further, it talks about $46.1 billion in this fund. So that means all of the people who are bought into this fund, who started the account with the $3,000, it's so many millions that they've got $46.1 billion in money to lend out to these different institutions. So you may be saying, who are they lending this money to? Well, I'm glad you asked. All right, because the portfolio composition says that they lend to energy sector, financials, healthcare sectors, 21% is going into healthcare. 8.8% is being lent out to companies in the industrials. 14.3% is lent out to companies in information and technology. 3.1 is lent out to telecom. 1.0 is lent out to technologies. And this is a corporate bond fund, guys. That means that they're lending this money to corporations, right? There's also municipal bond funds where they're lending money to municipalities. And then there's also government bond funds where they're lending money to the government for government programs and things of that nature. So corporate bond funds seem to pay out the most. But again, the higher the risk, the higher the reward. So I'm going to try to get into, before these last 5 minutes, let me see if I can remember where to go so you can see exactly who is actually borrowing this money. Let's see, portfolio management, I believe. Let's see. I can't remember, guys. But again, when you're doing this on your own, you have the time to play around with this thing to see exactly where everything is and get more comfortable with it. Let's see, when's it fun? Let me see if I can find out who they are lending this money to, because that's always cool to know. It might have been on the first page. View products and reports. Let me see. Because it's cool to know this kind of stuff, man. Portfolio holdings. Sorry, guys. All right. So I want you guys to understand something else about, how wealth is built, because you're going to be surprised when I run off this list of names of all the people who are borrowing money from this particular fund. And I'm talking about corporations. So all right, so you're talking about Microsoft, Pfizer, JP Morgan, Wells Fargo, Philip Morris, Bank of America, Johnson & Johnson, PNC Bank, Oracle, Verizon, Air Products, Anthem, Citigroup. Any of you guys recognize any of these names, right? So what they do is they take this money in these funds and they go buy tons and tons of shares of these company stocks. And that company takes those that money and then they, of course, use it to grow their infrastructures and all of that kind of stuff. And they're paying back dividends to the funds. But they also loan this money to a lot of these companies as well. So let me see if I can go to see who's borrowing the money. That's where I was trying to get to, guys, because you'll see that a lot of these same companies, you know, are taking out loans of, you know, 4 million, 5 million. You think when Verizon wants to run a campaign to try to add 1 million customers to their customer base, they're using their own money for that? No, they come into an investor like this and they borrow money. All right, we're running out of time, guys, and I can't seem to find that piece. But at any rate, hopefully, guys, this was helpful, and you see that. Oh man, I really wanted to show you guys all the companies that are actually borrowing money from funds like this as well. But at any rate, let me stop the screen share. So guys, hopefully you learned something, you know, as it relates to that, and you see that you have to have some money to go to the table. But when you start that fund with $3,000, guys, you don't have to put $3,000 a month into it. Once you get it started with $3,000, you can put $50 a month in it, $100 a month, $200 a month into it. and it continuously grows at the rate of 10.59%. Right? What does the rule of 72 say? The rule of 72 says you take your interest divided by 72, and it will tell you how long it will take your money to double. So if you just put $3,000 in there, 72 divided by 10 is 7.2 years. So every 7 years, in 7 years, that's 3 is going to 6. 7 more years, that 6 is going to 12, and that's if you don't contribute any more to it. But you continuously contribute, and you see how the rich gets richer because they know this stuff. This is the game, guys. You got to understand this stuff. So we're at the bottom of the hour. Again, the show is sponsored today by myself, Financial Health Mentor. I'm doing a live wealth building workshop at Willing Workers Church Saturday, August 20th from 1:30 to 3:30. Go to the address is 5631 Wells Avenue, St. Louis, Missouri 63112. So if you're in the St. Louis area, send me a message. I will send you the link that you need to go to get your Eventbrite ticket to RSVP. The space is very limited, but I want to touch and teach and train as many people as possible. And we'll talk a little bit about this, but more importantly, we'll be talking about our income shifting strategy on how you can put yourself in position to eliminate your debt, create that emergency fund, and then you will have that $3,000. I didn't even show you the $10,000 minimum requirement, the $50,000 minimum requirement. If they have a minimum requirement of $3,000 where you can earn 10.59%, what do you think you can earn if they have a $50,000 minimum requirement? Come on, guys. That's where the game is played. That's why the rich get richer, because they understand how to put their money in places that will outpace inflation. We're working a job, and our job raises do not keep up with inflation. So we fall further and further behind, and their money outpaces inflation. So they're falling, racing further and further ahead. So guys, I'm at the end of the show. If you're in the St. Louis area, come check me out this Saturday, 1:30 to 3:30, live wealth building workshop. You can ask all your questions. We can chop it up. I'll give you a real game plan that you can start building wealth that day. 5631 Wells Avenue, St. Louis, Missouri 63112. If you got questions, then you can text me at 314-874-6887. If you need directions or anything like that, I'll try to accommodate, but people are flooding in, so I don't always get back to everybody. Best thing to do is go to my fan page, click on events. You will see the event right there where you can RSVP, and you will get all your directions and everything right there. So guys, until I talk to you in tomorrow's show, where I'll be talking about tomorrow why I give up so much free game, right? Because in my hood, they say the game is sold and not told. And you guys witness that I give it to you for free. I'm going to talk about why I do that and why I have such a passion for this kind of stuff. We'll talk about that tomorrow. So until I talk to you then, I want you to get your money up, because you absolutely can do it. Peace out.